Welcome back to the deep dive. Today, we're tackling something really crucial. We want to give you the ultimate shortcut, basically, to understanding the stock market fundamentals.
Yeah.
Maybe you're prepping for a meeting. Maybe you've just decided, okay, finally, I'm opening an account, but you just feel swamped by it all. The jargon, the
Oh,
headlines.
absolutely. That anxiety is totally normal. It's what keeps so many people just sitting on the sidelines, unfortunately.
Right.
So for this deep dive, we've looked at sources that really try to cut through that noise. Our mission here is pretty simple. Pull out the clear, actionable stuff anyone needs to start building wealth. You don't need to be a Wall Street whiz for this.
Perfect. Let's just demystify it right away then.
Yes.
We need to start with the absolute bedrock concept. Forget the flashing tickers for a sec.
Yeah.
What is a stock? Like fundamentally.
Right. It's actually incredibly simple. A stock is just a tiny slice of ownership in a public company. We tend to overcomplicate it, but that's really it. When a big company, say a tech giant or whatever, needs, billions to grow even bigger,
Right.
they sell off tiny pieces of their future profits, their assets, to the public. That's a stock.
I really like the pizza place analogy that one of our sources use. It makes it so much more tangible. Can you walk us through that?
Yeah, absolutely. Imagine, like, a super successful local pizza place. They've got maybe 5 shops, doing great, and they want to expand massively, maybe to 50 locations.
Okay.
So instead of one huge bank loan, they can go public. They might sell, say, 100,000 shares, these little pieces of ownership.
Uh-huh.
When you buy one share, you literally own a tiny fraction of everything. The ovens, the brand, their future profits, the whole expansion plan. You are, in a small way, a part owner.
Okay, so if I buy, let's say, 100 shares of Apple or Amazon, does that mean I get to, vote on the next iPhone design or complain about the CEO? What does that ownership actually mean for a small investor?
Huh. Yeah, good question. Now, for almost all of us small investors, you're not really getting direct influence like that. The real benefit is financial.
Right.
Owning that fractional piece means, well, 2 main things can happen. One, the company might pay you dividends. That's like your share of the profits they decide to distribute.
Okay.
And 2, maybe more importantly for growth, if the company does well, gets more valuable, sells more stuff, your little slice of ownership becomes worth more. The stock price goes up. That's the main way wealth gets built here.
Got it. So we know what a stock is now. Let's tackle the inertia, the why bother question.
Right.
Why take hard-earned money out of a, safe savings account and put it in the market? Our sources really hammer home 2 critical financial forces here.
They do. And the first one is really about defense. It's about fighting inflation.
Inflation, the silent money eater, as they say.
Exactly. It's not just some abstract economic term. It's the real fact that prices for everything generally go up over time. Stuff gets more expensive.
So that $100 bill I have today, if I just, stick it under the mattress for 10 years, what actually happens to his buying power?
Well, if inflation runs at the historical average, maybe around 3% a year, that $100 bill 10 years down the line, it'll only buy you, about $74 worth of stuff dies today.
Wow.
It loses a significant chunk of its real value. Money just sitting there is effectively shrinking in terms of what it can buy. So investing is fundamentally about trying to make your money grow faster than that shrinking effect.
And the stock market, historically anyway, has been the place to do that.
Precisely. Now, obviously, past performance doesn't guarantee future results. We always have to say that. But yeah, if you look at broad market indexes like the S&P 500, over long stretches, decades, the average returns have often been closer to, say, 9% or 10% per year.
Ah, okay.
So that difference, that gap between maybe 3% inflation and maybe 10% market return, that is how you actually build wealth that outpaces the rising cost of living.
That covers the defense, playing defense against losing value. What about the offense? The second big reason to invest, the one that gets all the hype.
Ah, yes. That's the magic of compounding. It really is powerful.
The snowball analogy.
The classic snowball rolling down a hill, exactly. Start small, pick up just a little snow, but as it gets bigger, right, its surface area grows and it starts gathering snow much, much faster.
Okay. Translate that to money terms. How does that work?
It means your investment returns don't just come from your initial money, your principal. They start earning returns on themselves. So if you invest $1,000 and it earns 10%, great, you have $1,100. But the next year, you earn 10% on a whole $1,100, not just the original $1,000. That extra $10 you earned, it starts earning its own return too.
Right. Okay.
Over just a few years, the difference might seem small, but over, say, 20 or 30 years, It's exponential. It can turn relatively small, regular investments into, well, a seriously significant amount of wealth. Time is the key ingredient here.
Okay, so we've got the why, fight inflation, harness compounding. But let's get practical. The how-to seems to be where most people just freeze up. They get the why, but starting feels like this huge, complicated thing. What's hurdle number one?
Hurdle number one is just opening the door. You need a brokerage account.
The middleman.
Exactly. You can't just, ring up Apple and say, hey, I want to buy a share. You need a broker. The good news is, these days, it's mostly online brokerage firms. You can usually set up an account pretty quickly right from your computer or phone. That's where your investment money lives.
Okay, account open, money's in there. Now the big question, what do I actually buy? The instinct for a lot of beginners is probably, I gotta find the next big thing, the next Amazon. What's the standard advice there?
Yeah, that instinct is strong, but the consistent advice, especially for beginners, is be really careful with trying to pick individual stocks.
Why is that? Too risky.
It's incredibly risky, often compared to gambling, frankly. You're putting all your faith in one single company's success. A much safer, more proven, and frankly easier strategy for most people starting out is to use index funds.
Okay, let's pause there because the terms can get confusing. We hear index funds, ETFs, maybe mutual funds. So if buying one stock is like buying a slice of that one pizza place, what's an index fund? How does that analogy work?
Great question. An index fund basically means you're buying the whole market, or at least a very big representative chunk of it.
The whole market.
Well, think of the S&P 500 index, for example. An S&P 500 index fund means you're not just buying a slice of one pizza place. You're buying a tiny, tiny little sliver of the 500 largest public companies in the U.S. all at once.
Ah, okay. All 500.
Exactly. And then the ETF part exchange traded fund, that's mostly just a modern way these index funds are packaged and traded. It lets you buy and sell that basket of 500 stocks easily throughout the day, just like you would an individual stock. So when people say low-cost index funds, they usually mean index ETFs these days.
That helps clear it up. But let me push back a bit, like maybe a younger listener would. If index funds just give you the average market return, and I'm young, shouldn't I take more risk? Try to beat the average? Why settle for average?
It's a fair question. But think about why diversification through index funds is so recommended. The goal isn't just maximizing short-term gains. It's about building wealth steadily and, crucially, avoiding major losses.
Right.
If you own that index fund with 500 companies and one of them, even a big one, has a terrible year or goes bankrupt, it barely makes a dent in your overall investment.
Okay.
But if you put all your money into only that one company, you can be wiped out. Index funds basically eliminate that single company risk. You're betting on the overall long-term growth of the economy, not just one horse.
Diversification, the only free lunch in investing, they say. Okay, that makes sense.
Yeah.
Now let's talk pitfalls, the landmines. Our sources spend a lot of time on the common mistakes beginners make. Knowing these can save a lot of heartache and money. What's mistake number one?
Number one is definitely trying to time the market.
Ah, the crystal ball problem.
Exactly. It's this belief, often driven by ego, that you can somehow predict the perfect moment to sell high or buy low. Guess what? Even the professionals, the supercomputers, they can't do it consistently. It's practically impossible long term.
But it feels so wrong. Like if the news is bad, the market's dropping hard every day, why would I keep buying shares that seem like they're just going down immediately?
That's the emotional trap right there. And the solution, the antidote, is something called dollar cost averaging, DCA.
Okay, DCA, what's that?
It's super simple, actually. Instead of trying to guess the perfect time, you just commit to investing a fixed amount of money, say $200, $500, whatever works for you on a regular schedule, like a first of every month, rain or shine.
Regardless of what the market's doing.
Regardless.
Yeah.
And here's the clever part. When the market prices are high, your fixed amount buys fewer shares. But when prices are low, during those scary downturns.
Ah, your fixed amount buys more shares.
Exactly. You automatically buy more when things are cheap and less when they're expensive. It forces you to buy the dip without needing courage or a crystal ball. It takes the emotion right out of the timing decision.
Okay, that's a big one. Mistake number two feels like the one that really tests people's nerves during a real crash.
Oh, yeah. That's panic selling. You absolutely have to accept the stock market does not go up in a smooth, straight line. There will be bad days, bad weeks, even bad years. Think 2008. Think early 2020.
Right.
The absolute worst thing you can do when you see your account balance dropping and fear kicks in is to sell everything just to stop the bleeding.
Why is that so bad? Isn't it cutting your losses?
Because you turn a temporary paper loss into a permanent real loss.
Mm-hmm.
And crucially, you guarantee you'll miss the recovery. History shows, again and again, the market always recovers eventually and goes on to new highs. Always. Staying invested, having patience, maybe even continuing to DCA through the panic. That's the superpower. That's what separates successful long-term investors from people who actually lose money in the market.
Yeah. Patience is the superpower. I like that. Okay, final trap. This one's less emotional, more math, but maybe just as damaging long term.
Absolutely, it's paying high fees. This is the silent killer of your long-term returns.
How so? We're talking about brokerage commissions.
Yeah, so commissions these days, most are zero. We're talking about the ongoing fees charged by some investment funds, especially actively managed mutual funds. They might charge, say, 1% or even 2% of your total investment value every single year.
1% doesn't sound like that much.
It sounds tiny, but remember, compounding. It works in reverse here, too. Fees compound against you. Imagine two people. Both invest the same amount for 30 years. Both get the same 8% average return before fees. Investor A is in a fund charging 1% per year, so they actually net 7%. Investor B uses a cheap index ETF charging, say, 0.03%, so they net 7.97%.
Okay. What's the damage over 30 years?
That seemingly small 1% difference in fees, Investor A could end up with something like 25% less wealth than Investor B after 30 years. A quarter of their potential nest egg just vanished into fees.
Wow. 25%. That's staggering.
It really is. And that's why the advice is, almost universally, stick to low-cost index funds and ETFs. Keep as much of your money working for you, not paying unnecessary fees.
Okay, so let's bring it all together. If we distill everything down, the big takeaway from our sources seems surprisingly simple. Like, investing isn't this complex code only geniuses can crack.
Not at all. It's actually more about discipline and good habits than genius. You don't need a massive pile of cash to start. You don't need to follow the market every second.
So the core principles again.
Own a piece of lots of great businesses, usually through low-cost index funds. Keep your costs incredibly low. Invest regularly, automatically, using dollar-cost averaging. And probably the hardest part, be patient. Let time and compounding do the heavy lifting over decades through all the ups and downs.
So if you, listening right now, have been on the sidelines, maybe intimidated, maybe waiting for that perfect time or for everything to suddenly make perfect sense, consider this your friendly nudge. The real cost isn't missing yesterday's gains. The real cost is losing today's opportunity for compounding to start working its quiet magic. The key really does seem to be just starting, even small, staying consistent, and thinking long term.